Good morning, all of you.
Good morning, ma'am.
Oh, that's it.
Good morning, ma'am.
Good morning. Oh, 5 are there. That's very good. Okay, I'm sharing news. Today and tomorrow, I'm taking elective paper, financial markets and services. Among you three, who are all, are you three financial markets and services only?
Yes, ma'am.
Right? Okay. Right. Okay, then I'll try to share. Here, my side, what do you call, no power. So I'm taking from mobile, share, document. No. Mm-hmm. Okay, I'm trying to share the screen, financial markets and services, syllabus. Is the screen visible? Please text in a chat box. So we have financial systems in India, financial markets, classification of financial markets, and second unit about money markets, third unit about capital market, and fourth is foreign exchange market, fifth is derivative market. So I'll cover important topics in these two classes. Okay. From the first unit, financial systems in India. Is the screen visible to you all? Please raise your hand. Screen visible? Hello? Hello?
Yes, ma'am.
So let me start. So financial systems in India, you have functions of financial system, components of financial system, financial institutions, financial markets, financial instruments, financial services. Okay. In this first unit, you better prepare functions of financial system and financial instruments. What are the different financial markets are? I took that class. Just write down. Financial markets. Yes. Is the screen visible? Financial market screen, please.
Yes, ma'am.
Yes, financial markets are visible, right? Okay. So here we have different financial instruments in India. Okay, organized sector, unorganized sector. Under organized sector, let us talk first about the unorganized sector. Unorganized sector, like the individuals on their own when run their business, financial activities, we call as a unorganized sector. Like example, you have money lenders, indigenous bankers, pawnbrokers, traders, and lenders. Okay. So money lenders are individuals who lend money for people who are in need, but they charge higher rate of interest and clearing the okay. The next indigenous bankers are the other type of bankers where they provide again through form as a association and they provide what do you call they provide loans to the people on a certain basis, keeping some assets or some securities against keep some security against the loans that they provide. Okay, so these indigenous bankers also charge some interest upon this, charge interest upon the loans that they provide. Next, we have pawnbrokers. These are individuals who take keep some gold or valuables with them and give loans to the people, and the interest they charge is higher. The traders and landlords who are into this giving loans and financial assistance to the individuals and their notes. So all these are not recognized by government and they don't have any registered firms. Coming to the organized sector, so, organized sector like standardized, they'll have a standardized rules and regulations okay which govern their financial dealings. Generally the RBI taken some steps to bring this organized sector into existence. Okay, under the organized sector again you have capital market and money market intermediaries. So capital market intermediaries means what? Generally like capital market, in the capital market financial assets for long term benefit or long term maturity, we deal in the capital markets. Okay, financial assets or instruments which have a long term benefit will deal in the capital market. Generally for a long term, like shares, debentures, investments in these securities of long term benefits takes place in the capital market. Okay, their maturity period is 5 years, 10 years, like that, sometimes more than 1 year. Also capital markets again we have different types of like industrial securities, say development banks, insurance companies, UTI in the sense Unit Trust of India, agricultural financing institutions, government pension fund, NSCL, etc., RBI, Exim Bank, NBFC. These all comes under the capital market institutions. Okay, industrial securities market, government securities market, long-term loans market. Okay, and we also can divide these industrial securities markets into further into primary market or secondary market. Industrial securities market. Okay, government, NSC and BSC. These are industrial securities we can divide into again primary and secondary, where first issue of the securities to the public or rights issue or private placements takes place under the primary market. Means when securities are issued for the first time, will take place in the primary market. Okay, deals with those securities which are issued to the public for the first time. Okay. Secondary market means where buying and selling of existing securities takes place. That comes under the secondary markets. And these secondary markets are we have stock exchanges, government securities markets, the government securities market. Okay, long-term loan market, agricultural financing institutions. Agricultural financing institutions means these are the institutions which provide financial assistance for the agricultural needs, long-term agricultural needs, we call as the agricultural financial institutions, like NABARD. NABARD is one of the example which provides financial assistance to purchase the agricultural equipments and fulfill agricultural needs of the farmers in rural areas. Okay. So they provide loans and advances at a lower rate of interest and to encourage the farming it is by the people, farmers. The next one is in rural areas. Next, insurance companies. Insurance is another capital market investment where it was a huge amount of funds. Okay, huge amounts, whatever the funds it collect from the public in the form of premium are invested in the large companies and mobilizes the funds. These investments is do with a very care and attention. Okay, and so investing in these insurance companies again provides. So see now you have LIC came up with a public issue recently because right. So that this again capital market means first issue of the securities takes place. Developmental banks. Developmental banks, they again allow like see. Developmental banks are again, see these are whatever development banks, insurance, UTI, agricultural financing institution, whatever are RBI, whatever are there, these are the institutions which provide financial assistance to the companies for long-term requirements. Okay, capital market intermediaries, these all are the capital market intermediaries, means people or the institutions which provide long-term financial assistance to the what do you call long-term financial assistance to the investors, okay, or companies. Developmental banks. Development banks are those banks which provide financial assistance for the development of the industries, both small and large industries. After that, we got so many other developmental banks for different purposes have been established. Okay. Next, insurance companies. Again, insurance companies also the same, which provide financial assistance to the companies in providing fulfilling long-term financial requirements. Agricultural financing institutions, I told you, like NABARD and all, are those institutions which provide financial assistance to fulfill the agricultural needs of the rural artisans. Next, IRBI, Industrial Rural Bank Institute. Means these are again a kind of institutions which provide, encourage the banks to get into open their branches in the rural areas, providing banking facilities at the rural areas. Okay, rural areas, and for the development of rural people, they provide banking facilities. And see, the banks, banking facilities are developed in the rural areas, and banks open their branches in rural areas also. Next, Exim Bank, like a bank which helps the traders who are involved in the exports and imports of goods and services. Okay, NBFC, non-banking financial corporations, Again, we have NBFCs like a hire purchase companies, leasing companies, investment companies, financing. See, these are all whatever we have seen. Development banks, insurance companies, UTI, agriculture companies, agricultural institutions, government institutions, IRBI, Exim Bank. These all provide financial assistance to the companies to fulfill their long-term requirements. Whereas NBFC means non-banking financial corporations. Means they provide assistance to the companies, but not in terms of bank finance, the non-finance activities, whatever there. In terms of non-financial activities or of companies, these NBFCs will provide assistance to the companies. So what are those? Hire purchase companies, leasing companies, investment companies, and finance companies. Yes, are you there, children? Hello?
Yes, ma'am.
As I'm taking in mobile, I'm not able to see you all. Yeah. So hire purchase companies. What is the hire purchase? In your third semester accounting, you learned what is hire purchase. Hire purchase, people provide some assets on a rental basis in lifetime.
NBFC means it's private.
Very good. So at the end of the period, if they want, they can own that. Otherwise, they can return it. So they're providing financial assistance in terms of a hire purchasing system. The next, leasing. Leasing again is a long period contract which is on a higher basis only, exclusively on a higher basis. For a particular period of time, a building, a machine may be hired, and after that period, that building or machine has to be returned to the owner. And huge heavy machines and tools or which cannot be purchased by everyone, but their need comes seasonally. Such things are hired on the basis of leasing system. So leasing companies provide the assistance to the companies in providing huge and heavy machines on lease basis. Investment companies. These are the companies which help the companies, corporations in making their investments, different investments, in guiding, providing guidance and guidelines and understanding the activities of investment. These investment companies provide assistance. Financial companies they provide finance in aspects of financial aspects of guidelines would be given. So these are non-banking financial corporations under capital market intermediaries. Coming to the money market intermediaries, we have money market intermediaries means a small short-term requirements. A market or the intermediaries who are involved in fulfilling the short-term requirements or day-to-day requirements of the companies in their daily business, we call as a money market intermediaries. And not only that, here the trading of existing securities takes place. Okay, in capital markets, trading of new securities issues, public issues takes place. Whereas in money market, existing securities trading takes place, buying and selling. So here we have not only that, they deal with the financial aspects of short-term requirements or day-to-day money financial requirements of the business. That is, first one is RBI. About RBI, again, you might have learned in your under your banking subject. RBI being a highest banking system in the country will look after the various functions like the issue of currency notes, regulating the commercial banks, okay, and assisting financial and provide financial guidance to the government and acts as a banker to the commercial banks. All these are activities of RBI, and it's as a part of it, RBI also has helped the companies in providing financial assistance, liberalizing rules and regulations, interest rates in those aspects. RBI is important. You can get a question. Next one is commercial banks. Again, commercial bank functions. Commercial banks which are under the RBI function with an object of making profits. They accept the deposits and pay loans, give loans to the customers. So that is how they run their activities they enroll. They create credit. Commercial banks create credit. RBI controls credit. Next, cooperative banks. Cooperative banks are another money market intermediary who controls the supply of money in the country. Okay. The next one you have finally SPO, SBR. Government treasury bills, that I can say treasury. So in government contracts, when funds are required by the contractors, generally in government contracts, the bills will be paid on a certain period, and the contracts last for a long period of time. But these contractors needs to mobilize the funds, right? So they cannot wait till the project or the contracts are completed, completion of the project or contract, and get the money. So in between, when to fulfill the financial requirements, this government issue these government treasury bills, which have a duration of 90 days, 180 days, like that. Using these treasury bills or bills of exchange, company can withdraw the money. So majorly these government treasury bills are for the who get a yes. Yeah. Next topic is that financial system in India. This already I said. Yeah, if you see the functions, provision of liquidity, like in because of the financial system in India, a company that major function is the liquidity of funds. Like, see, you have the savings, I have savings, but if we both are at our own places, how do we generate revenue out of our savings? Right? There is a mediator. That mediator will show us the way where we can get a good returns on our savings. So that's how there is the third party who is in need of funds will get these two funds, and we as a person owner of the funds get some returns by giving to that third party. So that's how this provision of liquidity, that is mobilization of funds, takes place in the financial system. Proper financial system exists. Which can be listed off. The next one is classification of financial assets. Classification of financial assets. Yes. What is that? Again, these financial assets or instruments, whatever are there, those are classified into different types based on their what you call based on their term and based on the money they possess. Okay. So marketable assets and non-marketable assets, that how you have the different types of assets. Next, marketable assets are like what are they, which can be easily transferable in the open markets for into cash without any difficulty, like shares, okay, government securities, bonds, all this. Next, you have non-marketable assets. Non-marketable assets means what? Again, you have different types of non-marketable assets, like bank deposits, public provident funds, insurance schemes, okay, company deposits, public offer certificates, all this. It means these whatever are there, see, marketable assets means which you can convert into cash. Say, for example, you purchase shares of a Reliance company. So tomorrow, if you don't want, you can easily sell and get the cash. Okay. If not shares, you might have purchased the bonds of Reliance company or Tata company. If you don't want, immediately in the open market, you can sell your securities and you can get back your money immediately. That's what a marketable assets we said. Easily in the market, capital markets or in the money markets, your assets can be exchanged or sold out. Bonds or mutual funds or debentures, whatever it is. But non-marketable securities or the assets means which cannot be converted or transferred easily into the cash, like a bank deposit. If you deposit your money in the bank, up to a certain period of time, you cannot withdraw. Even if you withdraw, you will lose some percentage of money before the date. A provident fund also same. Okay, insurance schemes also. If you invest in insurance schemes, that insurance schemes again, you will get only on expiry of the premium, means on the end of the policy period or an expiry of the concerned person. That's what, right? You cannot convert or exchange them for the money. So like that, you have deposits and public offer certificates. These are all non-convertible or non-marketable assets. Yes. Net cash is, which is a direct asset again. You have. Okay. Next, coming to the financial markets. This what we have seen: financial stock assets, cash, debt assets. Cash is cash which is directly in the business, issued by the RBI, okay, and Ministry of Finance. And these can be easily tradable and exchanged in the market. Debt assets. Debt assets is where organization generally issue some like bills of exchange or treasury bills, not treasury bill, bills of exchange, debentures, loans. This all comes under debt assets, which raise funds that you takes time. Stock assets. Stock assets means, see, is individual units we call as shares, and when these group of particular group of shares combined and sold in the market, and which cannot be split into small units, what we call as a stock. Say, for example, a company has a 1,000 shares. These 1,000 shares, 100 shares it wants to convert into stock of 10 each. So 10 financial intermediaries, financial markets. Now money market intermediaries. Money market intermediaries means which are small in means regular buying and selling of shares, securities takes place between individuals and corporate customers. Okay. Next, what we financial markets. We'll discuss this. Financial markets again, and yeah, different classification of financial markets. Financial markets again classified into two types. One is yeah. Are you following, children? Hello?
Yes, ma'am.
Are you following?
Yes, ma'am.
Yeah. I got doubt whether people are there or not. Financial markets is over. In the exam, you will get a question on importance of like a financial system, functions of financial system. Then under the financial intermediaries, you may get a question, classification, capital market, importance of capital market or money market. Instruments under the money market. Money market instruments, if you see, you have division. Call money market, commercial bill market, treasury bill market, and short-term loan market. Call money market means what? The special feature of this call money market is what interest rates varies from day to day and on hour to hour also. Okay, like generally in the business, the money between the banks, this takes place. Call money market means the funds are exchanged for a short period of time, that is 14 days. One day to 14 days. Within the 1 day to 14 days, the funds will be exchanged between the banks when in case of shortage of funds within the bank. So they provide high liquidity. Loans are repayable on demand at the option of either lender or the borrower. Okay. The next you have commercial bill market. We know about this commercial bill market, that is bills of exchange. Bills of exchange, which is one of the commercial bill market. General to which business takes place in general, like two parties on credit sales draw the bill. So this bill can be exchanged, discounted in the bank and take the advance. It's a kind of money market instrument with which this bill can be exchanged or converted into cash on discount with the bankers. Next you have treasury bill market. Treasury bill market means generally government issue these treasury bills. Government, like on the contracts, government contracts for the payment of government bills, these treasury bills will be issued to the contractors. Generally contract government contracts for a long period, and till asking the contractor to wait till the end of the project or the contract for the funds is difficult, because he cannot mobilize the further activities or continuation of a project. It's difficult. So what government do, issue certain treasury bills with a period of 90 days, 180 days to these contractors. Using these treasury bills, he can get the payment. Okay, he can use these treasury bills in the market and exchange with the related persons and get the payment of these treasury bills. So repayment is guaranteed. Okay, and highly liquid, government important instruments. So short-term borrowings can be made with the help of these treasury bills. The next one is, okay, the next we have, so these are the three types of money markets subdivided. The money market may be subdivided into call money market, commercial bill market, treasury market. Short-term loans, you all know, that is providing short-term financial assistance by the banks or financial institutions to fulfill the short-term financial requirements of the banks or companies. We have a short-term loans. Okay, that's one of the important question. The next we have, financial instruments. You have two types of financial instruments, like your financial markets, your instruments also. You have capital market and money market. Same way you have the instruments also, primary market instruments and secondary market instruments. Primary market instruments are generally issued in the directly to the investors. Okay, like shares. For the first issue in the capital market, whatever the securities are issued for the first time, those all securities or debentures directly issued by the companies to the investor, we call as the primary securities. Secondary securities means like securities which are like mutual funds, whatever are there, those are secondary securities. Okay, you have again short term, medium term, long term, like mid cap, mid cap. Okay, you have those who are working in the mutual funds who know about these terms. Short term securities, medium term, mid cap, short, small cap, large cap mutual funds are there. So those are depending on the period of the securities which can be converted. Next one is next. Let us see our syllabus once again. Financial market, financial instruments, financial services. Financial services will do in our financial services means what type of services they provide. What are the different services they provide under the heading financial services? Okay. Like financing services, like providing merchant banking, hire purchase, leasing, venture capital, whatever we have seen, those all comes under the financial services. Means instead of financial assistance, they provide the assistance to the corporations in fulfilling their requirements in terms of services. Okay, we have merchant banks, mutual funds, okay, venture capitalists, leasing, hire purchasing system. This all comes under the financial services. What do you have? Financial markets, meaning functions, market participation, institutional investors, banks, brokers. Yeah, let us see about this. Next, what do you have? Financial markets. Under the financial market, as I mentioned, you have money market. And the money market, difference between the money market and the capital market you can expect in the examination. These are financial services. Difference between the money market and capital market you can expect in exam. See, here it is. So money market deals with the short-term securities, means like mutual funds and all, which are not more than 1 year. Capital market deals with the long-term securities, which can be exchanged after 1 year only. The next money market is provide financial assistance to the companies in meeting their small business operations, working capital requirements. Money market provides the financial assistance, whereas capital market provides the financial assistance to meet the large term fixed capital requirements, trade and commerce requirement, long-term requirements of the company, whatever that, to fulfill that, generally capital market we go and their investments are huge and the funds get in return you get also huge. The next we have the other difference is I said, yeah, what are the instruments? In money market, short-term instrument, treasury bills, bills of exchange, okay, mutual funds, these commercial papers, certificate of deposits, these all we deal. And money market, you deal with shares, debentures, government bonds. Capital market, you deal with the shares, debentures, and government bonds. I deal with the bills of exchange, treasury bills, commercial papers. Right? Can I say again now these instruments, whatever are there, money market instruments and capital market instruments, again you can expect a question separately. Explain briefly about the money market instruments. Then you are supposed to write about bills of exchange, treasury bill, commercial papers, certificate of deposits, whatever are there. Okay. The value of money market instruments also given here is of large amount. Treasury bill is minimum of 1 lakh. Each cash deposit or cash is for minimum of 25 lakhs. Okay. Whereas money market, capital market instruments, small amounts for share value. Like by minimum number of shares you are supposed to purchase. Each share value might be 100 only. Sorry, 10 rupees only. But minimum number of purchase will be there. Means minimum you are supposed to purchase 100 shares. Like that you will have. So money market instruments, whatever shares, debentures or securities are there, those will be divided into small amount of units. Next one is, yes. Examples, commercial bank and central bank comes under the money market instruments, and developmental banks, insurance companies comes under the capital market institutions. In money market, the trading can be over-the-counter trading. Over-the-counter means on phone also you can do the transactions. But in capital market, it is not that. It is have a formal standard or some standard and formal structure is there. According to that formal standard and structure, through stock exchanges, capital market instruments are traded. That's all. Yeah, money market activities can be performed without any broker, but capital market trading requires some guidance from the brokers, at least in the beginning of the days. Next, features of money market. You can take this. What I did. Based financial services only maximum. Let me 1 second, please. In this, you also prepare about this Sebi, which controls the activities of stock exchanges. Okay, money market instruments. So please note down, children. Please note down the important questions I'm telling you in this first half of the financial markets and services. So today we are dealing with the financial markets. Under financial markets, you are supposed to talk about, concentrate upon what are the functions of financial system, the meaning and functions of financial system. Okay, then classification of financial markets. Classification of financial markets or intermediaries. Under the classification of financial market, you are supposed to be thorough enough with the organized sector, like capital market intermediaries, what are there, and what are money market intermediaries, organized sector. Instruments, money market instruments, capital market instruments. After money market instruments and capital market instruments, again you are supposed to talk about institutions under money. Difference between the capital and money market. The difference between capital market and money market. Yes. Instruments we discussed. Differences we discussed. The next, what do you have? Let us see about it. Sebi you will get under money market, secondary market. I said the primary market again classified into, capital market again classified into primary and secondary sectors, right? So primary market deals with the first issue of shares, debentures and bonds. Secondary market deals with the dealing of already existing shares and securities. That is what called stock exchanges comes under this secondary market. So what does stock exchange do? Stock exchange involves in the exchange of stocks. As I said, whatever stocks that you involve, you will get the good returns on that. So now present generation showing interest in investing in the securities, money market, trading in money market, which is secondary market. Stock exchanges are secondary market example. And these registering, listing, the companies listed in stock exchange provide safety and security to the investments of the investors. That's the reason why generally if the companies will register their names with the stock exchange. The listing, which is called listing. This listing of stock exchange or the companies with the stock exchange involves certain rules and regulations, terms and conditions. Companies which fulfill the rules and regulations and terms and conditions of stock exchanges only can be listed in the stock exchange. What you call display notice. Okay. And these stock exchanges provide benefits to society, investor, and companies. What are the benefits of stock exchanges that you go through? You will get this in your first semester also. You got this. You studied about the stock exchange. So revise all that of your stock exchange knowledge, what you learned in the first semester. We discussed and we explained the functions. So these stock exchanges are under the regulation of Sebi. Because, okay, stock exchanges keep some rules and regulations for the control of companies' activities, who are listing in the stock exchange. So that it provides safety and security to the investments of the shareholders. But what about what you call or I'm telling stock exchanges. Again, the activities of stock exchanges are supposed to be controlled. A superior authority is to be there. So that superior authority over the various stock exchanges in India is said to be Sebi. That is Securities Exchange Board of India. Earlier it is Securities Exchange Act 1956. Now it is Securities Exchange Board of India. So we are going to learn about this. This is a must question. Please do this. Which one? Security Exchange Board of India. What are its functions? What are its functions? Anything else? Anything else? Stock market, money market, stock exchange, Sebi. Sebi is the Security Exchange Board of India, and Sebi have a control over the functioning of stock markets. How these Sebi control and what are its functions, we will learn. We'll look at here. And in this statement of Sebi, no other information must be provided. Anything is that outside the statement only supposed to be provided. Okay. Yes. Not now. Please not now. I'm having an exam. Okay. Sebi gives a proactive functions of Sebi. Okay. Functions and powers of Sebi. These functions and powers of Sebi is also important. Please note down. After that, the committee of how the Sebi forms, what are the achievements, this is all not necessary. As I mentioned, I'm just covering only important because our time is very Done? Thank you. Just a moment. Yeah. Neha and Praveen, I hope you were there. In tomorrow's class, we'll deal with the remaining part of the syllabus and covering only important. Okay? Is that?
Okay, ma'am.
Right. Thank you.
Thank you, ma'am.